the daily edition of Market Wrap with Mo Ansari.
Brought to you by Compact Asset Management,
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. Let's go to a friend of mine. He's standing by right now. That's Mr. Stephen Hochberg. He's the chief market analyst at Elliott Wave International. He's the co-editor of the financial newsletter, Elliott Wave Financial Forecast, and he also writes the 3 times a week short-term update. Mr. Hochberg, welcome back to Market Wrap.
Well, thanks for having me.
This is something that you and Mr. Prechter have been talking about for quite some time, what we're starting to see in the markets. We were looking for the wave down in 2008. Was that wave 1, and then we saw in 9, and then we saw this rally which went into the highs that we were at a week or so ago, and this is the next decline. Is this wave 3 of this, or did this wave start earlier, or where are we right now on the wave count?
Well, it certainly looks like it, right. From October 2007 to March 2009 was the first leg down of what we think is going to be a multi-year decline. We've had a pretty good intervening rally that carried up into one of the upper end echelons of the target zones that we had for this bear market rally. And I think the odds are very good that the April 26 high at Dow 11,258 marks the end of the bear market rally, and this is the start of what we consider the next leg down. It's going to take us significantly below the March 2009 low when the Dow is at 6470. So we don't have absolute confirmation just yet, but it's certainly looking like this is the start of this big next leg lower.
Wait a minute. What you just said was this is not a garden variety correction. That's what everybody is calling it right now. That, look, we went straight up. We've had this rally from the March of last year, haven't really seen any major corrections, and this is just another garden variety correction because of Greece and all of this stuff. What you're saying is it's something more significant. What would tell you that this is more significant than just a garden variety correction?
Coming into the high, we had wide pronouncements of optimism and bullishness. So there was a Wall Street Journal op-ed piece saying Dow 11,000, just the beginning. Mm-hmm. We've had sentiment measures get to the extremes that were last seen in October of 2007. We had the rally retrace a Fibonacci 61.8% of the decline from October 2007 to March 2009. We've had record number of buying climaxes in the market at the high. That's when a stock makes a new 52-week high and then closes down for the week. It usually represents a period of exhaustion in the market. And so we've now rolled over, and then there are certain world indexes that have taken back the entire gains that they had since September of 2009. So we've had in literally 2 to 3 weeks a decline that's taken back almost 8 months' worth of gain. So to us, this is a strong signal that we're turning the corner here. Now, we don't have absolute confirmation just yet, but things are really looking on track for our forecast. And if we're right, the decline that started at the end of April is going to be extremely persistent throughout 2010 and well into the coming years.
One thing that Bob has talked about, and you've talked a lot about, Steve, is this debt bubble. That this huge bubble has been created, and it started to implode, explode, or whatever you want to call it, deflate with the consumer first. The consumer couldn't handle the debt, so it got shifted to the corporations. The corporations or the banks started to go bankrupt, so they shifted it over to the governments. And the government said, okay, we will come in and stand in. And now we're starting to see the first signs that sovereign debt, as it's called, is starting to fall apart. Is this really the last stand for debt? And if the debt bubble blows up, what happens next?
Well, the debt bubble is in the process of blowing up. It started, one arguably could say, in late 2007 when the stock market peaked, or maybe even early 2008 when the dollar made its low in March of 2008. Now, one of the main forecasts that we've had here at Elliott Wave International is that the U.S. dollar should surge higher, which is contrary to what most people believe. They think the dollar is simply going to fall out of bed and crash because of all the debt. But what we're saying is because of the debt, which is denominated in dollars, the dollar is going to rally because as dollar-denominated debt is extinguished, remaining dollars increase in value. So we've got the debt. What we don't have is the dollars to pay the debt, and that's why they're so valuable.
Yeah, Steve, one thing that doesn't make sense to me, and I was talking about this on the broadcast yesterday, it's like somebody hit their limit on their credit card and they can't pay the payments on that credit card. So the solution that they've come up with for Greece is let's give them some more debt. They can't pay the first part, so let's put them more in debt, so maybe they can pay the more debt that we put on them. What kind of solution is it when somebody is too far in debt to put them more in debt?
Well, of course, it's not a solution. It's just simply compounding the problem. And when social mood turns negative, like it does in a bear market where we are, that's when you start seeing the problems come to the forefront. And we're seeing the pushback against all this debt. We're seeing riots in the streets of Greece. We're seeing the emergence of the Tea Party movement here in the United States. Whether you agree with their political philosophy or not, the rise of the movement itself is typical of what's happening in a bear market when negative social mood comes to the forefront and anger and polarity start expressing themselves. People are pushing back against all this debt. And that's extremely deflationary because in a credit-based society, unless you can increase the amount of debt and credit flowing through the system, what happens is you can't service what you've got. Debt starts to contract. That's the definition of deflation, and that's what we're seeing here. But
I know that's something, but Steve, you are mentioning deflation. Right now, the conventional wisdom is out there. You talk to anybody. They're saying inflation is coming. It's just around the corner because all of this money that is being printed, it is going to create an inflationary wave. Why do you see deflation with all of this money being printed around the world?
Because of the perma-inflationists assume that you can simply expand credit at will, that the Fed will simply monetize all the debt out there and destroy their balance sheet, which will be hyperinflationary. But what we're saying is no, the Fed doesn't have unlimited credit. They're a bank just like any other bank, and they don't want to trash completely their balance sheet, number one. Number two, you have what used to be called the bond vigilantes. In other words, because all this debt is denominated throughout the bond market, if the bond market pushes back against continued expansion of credit, interest rates will spike, the value of bonds will go down, and that is deflationary in itself because the value of dollar-denominated debt will be contracting, will be losing its purchasing power. So what we're having here is simply the markets reasserting themselves. Well, actually, they've always been in control, but now it's coming to the forefront, and people are seeing the implications of what happens when the markets push back against a continued try at an inflationary expansion. People have been talking about hyperinflation now for years, and it still has not shown its head, and the reason it hasn't is because what's happening here is deflation as controlled by the bond market in not only U.S. but worldwide.
Steve, I know you're very, very busy today, and I appreciate you taking the time out today and being with us today and putting in all of this in perspective of where we are. And again, it's something that is not the conventional wisdom out there, that this is not what everybody's thinking. Right now, this is just a garden variety correction. Thank you again for being with us today and sharing your thoughts with us and giving us some clarification of where we are on this wave count and your views on what we're seeing in the markets today.
Thanks, Mo. I appreciate it.
That's Mr. Stephen Hochberg. He's Chief Market Analyst at Elliott Wave International. Interesting point of view. That's what I've said. I don't know if this is going to happen. No one does. But you need to have those tripwires. What he has done, and I really appreciate this, he has released his April, his financial forecast for us.